Hello, it's ChewDog Charts, and today we're going to talk about my two favorite things, the stock market and real estate. And when you put the two together, you get REITs, real estate investment trusts. And REITs are a special type of corporation that's federally obligated to invest only in real estate. So as long as the REIT pays out at least 90% of their earnings in the form of dividends, the companies are not required to pay income taxes. And as with real estate, REITs are impacted by interest rates. And recently, interest rates have been rising. But those who buy and sell on headlines mistakenly believe that real estate investment trusts will suffer if interest rates rise. Often, when the 10-year Treasury yield rises, REITs usually fall. And when its yields drop, REITs usually rally. This inverse relationship tends to hold up over multiple days, weeks, and maybe even months, but not necessarily in the long term. In the long term, it is possible for REITs and higher interest rates to coexist. Real estate investment trusts, like bonds, are high on the list of income investments, especially for those on fixed incomes. And REITs do have some advantages. Unlike bonds, REITs regularly increase payouts. That makes them more like a Treasury inflation-protected security or a TIP than a typical bond. REITs currently pay a 4% dividend yield on average, and they've been raising the payouts by about 6% a year. REITs have another form of inflation protection that bonds lack. Leases typically roll every 3 to 5 years, allowing for rent hikes. And lastly, with the 2017 tax cut, taxes paid by a top-rate taxpayer on a REIT dividend, their rates will decrease from 39.6% to 29.6%. So let's take a look at a couple of REITs. First up is Crown Castle International, and the symbol is CCI. Crown Castle International is an unusual REIT. Unlike normal REITs, which typically lease retail, office, industrial, or apartment space, Crown Castle owns the towers that carry your smartphone signal. There are two big advantages to this. First, it means that CCI is exposed to lots of growth, thanks to the huge appetite for bandwidth because of the popularity of videos on YouTube, Netflix, and Facebook. Smartphone service providers must keep putting more equipment on the towers. CCI's revenue growth recently was in the 8 to 10% range, and the company has been improving its guidance. Leasing activity appears poised to pick up in 2018. And next, CCI's customers are solid businesses that typically have good credit ratings. They include AT&T, Verizon, and T-Mobile. These companies aren't likely to stop paying the bills anytime soon, and that makes CCI's dividends more reliable. And recently, CC&I has been paying a dividend of about 3.6%. So now let's go take a look at the price chart. And we're looking at the 20-year monthly chart on Crown Castle International. Looking at the price chart, going back here to 2009, from that point on forward, it looks to be heading up on a relatively decent trend line. Mine isn't all that straight, but you kind of get the idea. It stayed above the 50 EMA and has hugged closely to the 20 EMA. Relatively strong here. Moving to the MACD, looks like we might have an interim high here with the fast line still above the signal or trigger line, but looks like maybe it's going to head down. So I would want to wait a while for that fast line to move below and see where it goes from there. Looking at the histogram, you can see that the top was here, then with just a couple of months of downward trend. I'd like to see that trend continue before I would say it's safe to buy. Looking at the momentum indicator, much the same. price rate of change. Looks like it's heading on up, but I imagine that will change too as some of the oscillators look like they're heading down. The relative strength index is at a moderate 59.68, but the trend line is heading down toward the midline or the 50 line. Now, here's an important oscillator. It's the stochastic. This looks like it has a decent pattern here. And right now, it looks like the fast line's about to move through the slow line. So before I purchased this stock, I would like to see this fast line come on down to that midline 50 line here before picking up any stock. It looks like that's been a good buy point in the previous years here, 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 and this one was a little bit elevated above the 50 line, and of course back in 2009 it was well below that. But that midline seems to be a pretty good indication of a buy point. Moving down through the volume looks fine, and through here to the Williams looks like it's heading on down as well. I would wait for the Williams to go below the 50 or the midline. Back up to the price chart here, and you can see that in previous buy points, the stock has approached, say, the 50 EMA going below the 20 EMA. So wait and watch for that to occur. And then at that point in time, conduct more due diligence. All right, let's go ahead and take a look at the next stock. And the next and last REIT is Education Realty Trust, and the symbol is EDR. An Education Realty Trust operates student housing in 26 states near 54 universities, including Auburn, Oregon State, University of Kentucky, and Texas Tech. Education Realty Trust had a tough year in 2017. Shares declined about 14% as an increase in overall college housing capacity weighed on rentals and growth. The company also saw delays in a project at Oklahoma State. But as the stock rattled around in the range of $35 to $37 per share, and it traded toward the end of the year in that range, the CEO stepped up and bought $875,000 worth of the stock at around $35 per share. Now, he might be betting on a projected tightening of new supply in 2018 relative to expected enrollment growth. This suggests capacity usage might increase in 2018 compared to the slippage in 2017. Education Realty Trust also has a pipeline of housing projects scheduled for Arizona State, Colorado State, Cornell, and the University of Minnesota, among other campuses. While 2017 revenue trends were sluggish, cash flow growth was good in the 11% range, suggesting the dividend is not at risk, and the dividend yield recently was 4.6%. So let's take a look at the price chart. This is the monthly chart going back to 2005 for Education Realty Trust EDR. And looking at the price chart, looks like we had a top here in mid-2016 with a downtrend going through here into early 2018. Moving into the MACD, it looks like the MACD fast line is still heading down with the slow line following, both going below the zero line. So some weakness here. Moving into the histogram, we can see that there is a possibility of a bottoming process here in this area. But let's go see here. The momentum indicator looks like it's still heading down after a pause here and back up to here, but still it reflected back down, heading below the zero line midline. Into the price rate of change, it looks like this is potentially bottoming here with this process there. Now go look back here in 2013, 2014 at that bottoming process there and see how that went. And here in 2008 into 2009, that took a little bit longer here. I would expect the current bottoming process to look more like this because things are not as severe as they were back in 2009. Moving down here to the relative strength, it's at a weak 25.42 and still heading downward, nearing the oversold territory, but not yet. Into the stochastics, it looks like we have a bottoming process here as well, with the fast line moving above the slow line and then just popping up, but then back down again. So we'll see what happens there, but look for a process something like this, again here. This took a little bit longer in 2009, but perhaps we do have some sawtoothing that may happen here a little bit longer. But it does look like it's attempting a process, at least by a few of the oscillators. The volume looks good with a good increase continuing here. Now we do have some pretty heavy sell periods, but I do like the increased volume on an overall basis. Moving here into the Williams, it certainly looks like the Williams is spending a lot of time down here in the oversold territory, perhaps part of its bottoming process taking a little bit longer than it did certainly here and even here, but it also looks a little bit longer in length than it did here in the 2008 to 2009 time frame. But let's keep an eye on that. Moving back up here, what I'd like to see is some congestion in the price right in this level here to give me an indication that there's some sort of bottoming going. A couple of months here was your signal. Back here, it took a little bit longer. So I would imagine perhaps that this current bottoming process, if it is a bottoming process, is going to be extended. So wait a few months before you make any decisions, and certainly continue your due diligence. So for today, that's ChewDog Charts. Thank you.